Ladies and gentlemen, thank you very much, and thanks in particular for investing your time today in learning a bit about APN Property Group. So we have prepared a short video, but it will be available on the ASX, and we'll give you the link there if you'd like to see it. It's fairly high level, but We'll move right into it. So APN Property Group, we're a specialist real estate investment manager. What does that mean? We are exclusively focused on commercial real estate, and the way we do it is our overarching philosophy of property for income. So all of our investment products have a focus on reliable cash rental income streams. So today, the company manages about $2.9 billion of commercial property investments on behalf of retail clients and institutional clients across Australia, as well as some institutional international investors. We have 12 funds, 105 properties and 48 staff headquartered in Melbourne. So in terms of our, what sets us apart, what gives us an edge, it really comes down to four things, the way we think about it. The first thing is our track record. So the business was established in 1996, so we've got well over 20 years of experience in managing investments. We've learnt a lot in that time, and we believe fundamentally our track record is a part of our competitive advantage. The second thing is our investment experience and expertise. So we make a conscious decision to find the very best people for each of the parts of our business, whether that's real estate securities or investing in office buildings or office or industrial assets. Finding the very best people in their given field is a key part of our strategy. The third thing is you may be familiar with the concept of skin in the game, and we describe it as alignment. So APN, our company, is owned about 30% by its board and the management team, and our company in turn has over $100 million of our equity, our balance sheet, invested in the funds that we manage. So we have a strong degree of alignment. And then finally, governance. We invest heavily in our governance, that's personnel, that's systems, processes, as well as having a completely independent trustee board with some very well experienced and credentialed investors. So how do we generate our earnings? This is a simple overview of our business model. Essentially, you can see here we have our investors that essentially pull capital into funds, and we make investments on their behalf. So really, we do two things. The first thing we provide is management services to the funds that we manage, and the second thing we do is we co-invest. We invest our own equity, our own cash into those investments. So in return, we generate fees for providing those services, and we also generate co-investment income. So if you think about the business in those two buckets, on the right-hand side, you can see in the grey, that is our co-investments. So we have $16 million of cash and $127 million of co-investments. And then on the left-hand side, we have our funds under management. And this includes our real estate securities division with about $1.7 billion of assets under management. This is investing in listed Australian and Asian listed property trusts. So it's got a diversified portfolio of underlying assets. It's fully liquid, and the funds are open-ended there. We have two of our own REITs, both of which we have listed ourselves on the ASX in 2013 and then 2017. You may be familiar with these vehicles. You may have come across them. APN Industrial REIT's a $750 million office and industrial portfolio, and then APN Convenience Retail REIT owns a long lease term portfolio of convenience retail, principally service station assets around Australia. And then we have an unlisted funds business. So this part of the business will own direct property assets in fixed term funds, whether that's office, retail, industrial, mixed use assets. So what do our products do? Fundamentally, we're an income-focused investor. Property for income, if there was one phrase which I guess summarised our investment philosophy and the way that we have gone about what we do for the 23 years we've been in business, it would be this phrase. So our view is fundamentally that we believe a good commercial property investment will be able to generate a sustainable cash rental income stream. So real assets, we're investing in bricks and mortar. We have a strong focus on cash rental income streams. So that means long-term leases, quality businesses and governments as our clients across the business, delivering relatively high cash distribution yields with relatively low levels of debt. We say that we're not shooting the lights out, but we're after long-term compound growth and strong income returns. So if you think about commercial real estate as an income investment, this chart really, highlights the benefits of the asset class and why we're so passionate about it and why we think it's such an important part of investors' portfolios. So, what this chart shows you is the quarterly returns for Australian commercial real estate. Every quarter back to June 1987. So the orange is the total return, and that's split out with the blue bars being the capital growth, and then the orange being the income. And that's really our focus. Our view is as a long-term investor, if you focus on the income, the total return will look after itself. And you can see the quality and the consistency of the income returns across commercial real estate. So that sustainable cash income is really what we're looking for in the way that guides our investment approach. So what's driving our business? If you think about the industry backdrop and where we are, we're certainly not investors in high technology. We're not manufacturing. We're in a particular part of the financial services landscape, and that we're benefiting with a very strong tailwind through the superannuation system. So Australia has one of the world's leading pension markets in terms of its sophistications, as well as its size relative to our population and, say, the market cap of the stock exchange, the ASX. So we now have $2.8 trillion of assets in superannuation, and that's growing. So really this is a key driver for our business and the industry we operate. The second thing is the need for retirement income. So whether our customers, our clients are very large Australian super funds or international institutional investors or mums and dads, retail investors, fundamentally what's driving them is this need for retirement income. So our average client, whether they're in a large super fund or investing directly with us, is typically looking at their retirement income portfolio. So common questions: how long is my retirement income going to need to last? What is my healthcare going to cost? And so a very common approach is to look at a pool of capital preservation, and then living off the income. So our products are really designed to deliver that regular, sustainable income. You can see here, this is one of the recent advertisements we've run in the Age and the Herald Sun as an illustration. And you can see here, I think it's not news. I'm certainly not suggesting that all of these asset classes have the same risk-return profiles, but you can see for investors that are looking for income-orientated investment products, relative to the yields on offer in cash. These are 5 of our real estate funds. You can see the income yield that you're able to generate is significantly above where cash, and even if you look at fixed interest and bonds, we see a significant spread there. So this is fundamentally why we're so confident about the business and the outlook in terms of how we are positioned in the investment market at the moment. To give you a sense of the funds on the previous page and the investment yields and what's sitting behind them, as I said at the outset, we're very much focused on a conservative, long-term approach to investing. We have a significant amount of money of our own balance sheet invested. So to give you an illustration, APN Industrial REIT, this is a high-quality office and industrial portfolio. It sits in a fund that's listed on the ASX, so it's fully liquid. It's nearly fully occupied, 97%. It has a weighted average lease expiry, so the average term of all of the leases across the portfolio is over 6 years. It's gearing, so the ratio of debt to total assets is 30%. You can see that typically compares very conservatively against the way that most residential property in Australia is funded. And you can see it's offering what we would say is a very attractive cash distribution yield, 6.2% on the current trading price. So you can see this, the growth in this vehicle. So we listed this fund in late 2013 with about $380 million of assets. Today it's closer to $770 million with a couple of recent acquisitions. Similarly, convenience retail REIT. So this fund invests in a portfolio of long lease term convenience retail assets. We say there it's a non-discretionary retail focus. So this is really serving people's everyday needs. In this case, fuel and convenience retail purchases. We listed this fund in 2017, and with recent acquisition announcements, we're now to about $430 million of assets. Again, relatively conservative gearing at 35%, a cash distribution yield for investors of 6.5%, and a weighted average lease expiry of just under 12 years. As an example of our securities funds, This fund, our APN Asian REIT fund, this fund was established in 2011. It has delivered a 15.5% return since inception, again following a very much an income-focused investment approach, and invests in listed REITs, principally in Singapore, Hong Kong and Tokyo. The fund invests in one of the world's largest growth regions, 50% of the world's population based in Asia, and it's offering a distribution yield currently of 4.9%. You can see this fund is now, it's about $54 million as of today. So we'd see this as one of the company's key growth products moving forward. The sector it's in is about $300 billion US dollars. It's growing at about 4 times the size of the Australian REIT sector. So we'd see this as a key growth opportunity for the company. So that's an overview of our products. I mean, what does that all mean? How's our management company been performing? I think often people are quite surprised when we show them the results. We certainly have taken a considerable effort to make sure that we have long-term sustainable growth opportunities within the business, and really these numbers give us confidence that the strategy that we've put in place in early 2013 are delivering results. So you can see here our recurring income growth is growing at an annualised rate of just over 16%. Our funds under management have grown at over 10% year on year for the last 10 years. We've delivered total shareholder returns over the last 5 years of over 26% per annum. And our distributions have grown at over 17% per annum over each of the last 5 years. So what that means now in terms of how we're positioned as far as the quality of the earnings stream and the quality of the balance sheet, when you look at the breakdown, this is a breakdown of our income statement, our P&L from our FY 2019 results presentation. We have a very large percentage of our earnings that are generated from long-term management contracts. We have very little reliance on performance fees or I guess less sustainable revenue lines. So you can see here funds management fees, that's from generating annual management fees from the funds that we manage. Registry fees, our co-investment income, these fees are and these revenue items we'd say are very much sustainable. So that we would say that the quality of our earnings as we sit today are very high. The second thing, the balance sheet. So we believe we're very well capitalised for future growth. We have a conservative approach to the way we operate the business. We have $16 million of cash and we have debt of $6 million. So we're net cash and our net tangible assets, so principally that's our investments in our 2 listed REITs, that equates to about 40.2 cents per share. So we've got an excellent book value or balance sheet backing behind our share price. So what that means, if you think about it in one perspective, and a number of our shareholders ask us to generate this analysis. So what that means here, you can see on the left-hand side of the chart, that is a breakdown of our net tangible assets, the company's book value essentially. So that sums to 40.2 cents per share. So what that means in some respects is that the funds management business, our business that sits beside our co-investment income, equates to 9.8 cents per share if you're looking at what you're buying when you buy, if you were to buy our shares at 50 cents per share was where they were trading at 30 June. So for $2.9 billion of funds under management, that equates to about 1% of funds under management. In terms of our yield on the income statement, our FY20 distribution forecast of 3.15 cents equates to a distribution yield of about 6.3%. So look, thank you very much for your time. That brings us to the conclusion of the presentation, and I'm happy to take any questions. Okay, Mark.
Just touch on the staple proposal and then what it means.
Yeah, sure. So for anyone who didn't hear that, so we have a proposal that is has just been sent to shareholders to convert the company into a stapled structure. So what that means is we currently operate as a company limited by shares, but we have, as I mentioned, about $127 million of co-investments, so investments in our funds. So the proposal is to transfer those investments in our property trust to a trust and turn the entity into a company, a share in a company, stapled to units in a trust. So that's very similar to the way some of our peers operate, Land Lease, Charter Hall, Centuria. We expect that will bring us more into line with listed real estate investment managers across Australia. It means that the trust distributions, rather than being taxed at the company level, and paying sort of 27.5% on that, and then paying a franked dividend on that component of the earnings, it'll be passed through to our owners, our shareholders, and taxed in their hands. So we think overall it should deliver us a cost of capital improvement. So that's the materials went out last week. There's a vote at our AGM in November, and we had a previous I think the shareholder feedback that we've received from our previous consideration, that was very positive. So thanks.
Thank you for the presentation. It's great. Got a question about one of your charts where you had a total return chart.
Yes.
And noticed that in the periods that coincided with the Asian crisis and the GFC, your total returns was negative. Is that because
this chart?
Yeah.
Yeah, so this chart is not APN specific. This is the sector as a whole. So this is illustrating all commercial real estate asset classes in Australia, so carving out residential. And yes, you're right. So this in the early 90s, we had a huge oversupply of commercial office space, and you can see there that the total returned to negative for a period, as it did in the financial crisis. But I guess the point of this slide is for investors that are long-term income-focused investors, which is really the way we believe you should think about investing in real estate. You see these big rallies off the back of it. So what we've seen is that the income performance provides an excellent, base to your total return. So if you take a long-term view on commercial real estate investing, if you can deliver sort of a 5 to 7% annual income return over time, I think the overall return over the 30 odd years that this chart represents is about 11% per annum. So you can see on a long-term basis, you're getting a significant component of your total return from the income, and then over time, the capital growth, the capital growth side of it will average out. But yes, you're right. I mean, like any asset class, there have been periods that have represented excellent buying opportunities, and people have done particularly well in those periods.
Was those falls and was that capital values because the properties were written back to market values?
This chart would always be based off market values, but so in the early 90s, an oversupply of commercial space you see the previous period. There was probably 20% per annum for a series of years prior to that in terms of capital growth, which was really, I guess, a boom that then corrected. So, basically that was the valuations. A bit like if you use a residential property context, what's happened, say, in Melbourne CBD apartments in recent years is, we've seen values after running very strongly up, it's come back somewhat. So that's all that represents.
Any other questions? Will the slides be on the website?
Yeah, they're all posted to the ASX this morning, including the video I mentioned. Or feel free to contact me if you need any other information. We're happy to have a chat. But yes, they're all on the ASX and on the website.
Tim, you mentioned about the stapled securities. I'm just wondering what is the impetus for doing it now rather than previously, given a number of your competitors already have that structure?
Yeah, it's probably taken us about 12 months to implement, just with the regulatory approvals that are required. Basically, what's happened with our business is, say, 6 years ago, our market capitalisation would have been about $30 million, so we're probably close to $170 million today. And the big growth in the business has been our co-investment, our balance sheet, component of the business, where we put this up here. So you can see here the grey. So if you looked a few years ago, our balance sheet wouldn't have been nearly as significant, so we wouldn't have really had the rationale for doing it. I guess the composition or the percentage of our earnings that were coming out of our balance sheet investments would have been much smaller relative to the whole. So as that's evolved and changed, it sort of meant that the business case for doing this has changed. That's the real reason.
Okay.
Well, thanks very much.
Excellent. Thanks very much.